Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over kind of how I view the markets, how I find potential investments, what I look for. And the only way that so there's people that like divide people up. They say technical analysis and fundamental analysis. I don't agree with that. It's all like this. No, it's like this. It's all together. It's all one. It technicals are fundamentals, fundamentals are technicals. The only time I invest in commodities is if we have certain market conditions, where the wind is at our back, is what I usually say, which means that we could be sitting on a tube and it just blows us downstream. That's when you want to be in those types of investments. You don't want to be in it if the market conditions are not ripe. So, how do you tell if market conditions are ripe? There's a couple of ways you can tell. I use ratios, and what ratios tell us is where money has flowed, where it is flowing, and where it has flowed from. If a ratio is getting cheaper, if an asset versus an asset, if they're being priced against each other and they fluctuate over time, the only way that they can fluctuate is if investors prefer one asset over the other. And that would mean that it would gain in value against other assets. We want to know what the cheapest assets are and that they are improving. That is where I want to go, quote, fishing for companies or stocks. I will not fish for companies or stocks if they're overvalued. There's no reason for me to be there. There's no upside potential with a low downside risk. So uh, what you're doing is you're waiting for the stars to align for certain sectors for this alignment. Once you get that alignment, then you go big. You go big because you have the market conditions that are changing. You've got the ratios that are changing. And you have assets, and the way that those assets are being viewed by the markets are changing. So, how do we identify all of those things? How do I identify that the market conditions are changing, that the ratios are changing, and all that stuff? So let's dive in here. I've got some information that I'd like to share. This is the commodity to stock ratio, and there's like a ton of different ratios that you could look at. One of the spots that I like to look at is long-term trends. That's a website here where you can see a whole bunch of different information. The Buffett indicator, market cap to GDP, stocks versus gold and silver, stocks versus bonds. I'm sure you'll see that stocks are ludicrously expensive here and here. We're at bubble territory. And then the bottoms are, 1940 would be a good spot. In the early 40s to get long stocks. Get long stocks in 2009 would be a good spot where it was bottoming out. But now we are at the upper levels here, and there's no way I'd be in that. We've got stocks versus real estate, showing that stocks are very expensive to real estate, and that real estate will probably outperform stocks for a little while. It's just money rotating between assets, and what we're doing is we're identifying where the money is at and where it isn't. And right now, it is at stocks. That's why all of these charts are signaling that they're expensive. Here's the gold to oil ratio, or Dow to gold ratio. And I think that this will eventually fall. Why do I think that? Because of high inflation and increasing interest rate environment. The last environment that we had a big inflation and increasing interest rate environment was back in the 60s and 70s. You can see this thing kind of went sideways and then blew out in the 70s, where gold outperformed the Dow. I think that's coming here very shortly because of interest rates and inflation. So I'm looking at all of these types of ratios, and you can see them all in long-term notes. Long-term trends. We've got, the oil to gold ratio, and this thing's pretty crazy. I'll show you what I mean by this. I'm going to do a quick just snapshot of this. I'm going to throw it in paint. And what I'm looking for are trend changes. Trend changes are changes that are broken from a trend. See, we were in this downtrend, and all of a sudden we have gone into an uptrend. So this here is a new uptrend. That's what we broke, and that's exactly what I look for. I look for changes in trends. So this is a change in trend of oil to gold ratio, where oil is going to start to outperform gold. It's a big deal. I look for, here's oil. Oh, that's gold to silver ratio. This will go lower. You've got a trend line here that broke to the downside. It's just doing a retest move before it heads lower. Silver's going to kill it. We've got U.S. debt to GDP. It's probably going to go way higher. We've got money supply, M2 money supply growth. It is dropping down some, which means that the inflation could pull back a little bit with time. But it's still at very high levels in terms of the M2 money, because the red line of inflation will just follow the M2 money supply, delayed by some measurement. So it's pretty easy just to look at the M2 money supply and then watch that. And as long as this is high, above 10%, that's a pretty high number. But I look at long-term trends to get kind of my basis on what I think is good. I look at the CRB to S&P 500. This looks like it's bottoming and turning back up. It's broken the downtrend line. And then we've got the break and run. So that there means to me that commodities are the spot to be. Money is rotating into commodities in relationship to the S&P 500. So I'm looking at a lot of commodity sectors. And I usually look at a asset versus asset against gold. Gold's kind of the gold standard. So platinum, I think, since we've broken the downtrend, the trend is broken. I think that we're going to eventually go higher. It doesn't mean that it has to go higher, and it doesn't tell you the time frame, but it tells you that the asset's cheap and that we're about to reverse course. The downtrend's broken. So I look at all these different ratios. And I look at all the ratios and I find ones that are really good, that look like they're going to outperform everything. For example, uranium. So uranium to silver ratio, it's breaking out to the upside, favorable for uranium. The uranium to S&P 500 is favorable for uranium, so that's breaking to the upside. We have uranium versus gold, breaking to the upside for uranium. We have uranium versus crude. This is a tight match. We'll see which way that one goes. And then we've got uranium to copper. Uranium's going to outperform copper, it looks like, because it's breaking the trend. So I'm looking at the trends. And then the absolute value of uranium to gold is very low. It's cheap in relationship to history. So this valuation has a long runway to run against other assets, meaning that uranium is incredibly cheap. So uranium's cheap to everything else. It draws me to that sector because, one, it's highly leveraged by the ratio move. The size of this thing, of what it can move, means it's the potential valuation it can gain against other assets. And you can see that, uranium could gain massive amounts against gold. It can gain massive amounts against crude oil, potentially. We've got copper that it gained quite dramatically before. And we've got a large gap between uranium and silver, even, where we could gain way back to the peak of a 6x or 5x or so, 5x or so. So that is one of the sectors that I would look at. So now that uranium is looking, is looking good from a ratio perspective, I go and I start looking at uranium itself, the price. The price of uranium is rocketing. It looks really good. I'm looking for bottoming patterns. I'm looking for patterns that are breaking downtrend lines. There's a broken downtrend line. Then you look to see if the momentum is shifting. The momentum is lower, then it goes sideways, and then it looks like we're coming back up. And we've got a broken pattern here, basically, that we've seen. You see this pattern all the time, where it kind of comes down and then it just slowly keeps going higher. The lows step up into the trend line and then finally break. And that's exactly what I look for. So uranium looks absolutely excellent from a valuation perspective, from a market conditions perspective in terms of commodities outperforming the S&P 500. And the inflation in the system is still there with an increasing interest rate environment, which causes money to rotate into commodities. Check, 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 check on everything. So then I start looking at particular companies. I'm looking for bottoming patterns. And URNM, this is an ETF. We've already bottomed, and we've been moving on up, and we are moving higher. It's looking fantastic. Bannerman was one that had a very nice bottoming pattern. It was a nice, good wedge. There's your wedge. And what I look for is I look for a squeezing up or a bottoming, like a double bottom pattern or a wedge or something. And I look for the large candlesticks up and the leak off of sellers. I look for that type of pattern. And there was a step change here from this way is different looking than this way. And then the volume stepped up. The volume stepping in and buying all this. So this is a bottoming pattern. And I loaded it over here on the right-hand side in 2020. Then we took off. So that's what I look for. I look for the bottoming patterns. And then I look at what this company is. What's the valuation of the company? Because this is a developer. What's the enterprise value in relationship to the assets they have, and how does that compare to everyone else? Bannerman is one of the cheapest companies based off of that metric. And then the next question I ask is, why is it cheap, and could this valuation change? And if it's cheap because there's a reason behind it, it's a high-cost producer, I find that as a great thing, because high-cost producers usually go up the most during a commodity bull market if I'm a big bull on the commodity itself. So usually the high-cost producers are the ones that have the largest returns. They're also some of the ones that lag the most. Either explorers or high-cost producers or companies with a lot of debt, whatever it may be. And depending on where we are in the cycle, you might load up on the strongest companies, you ride them higher, and then you might buy other companies later as things progress. You might go to high-cost producers, you might go to companies that have a lot of debt, and you'll ride those later in the cycle because they respond to the price move. And then I look for strong up days or months, strong up months, small pullbacks. This one looks excellent for a move higher. Looks absolutely excellent from a technical perspective. Goviax is looking excellent. We're sitting on top of its pattern. And the whole sector here looks excellent. Why is that? Why does the entire sector look excellent? Because we already did our homework. Commodities are going up. Money's rotating into commodities. Uranium's going to outperform everything. We should see the patterns in this sector support and outperformance. And we do. We do. We're starting to see all these companies break downtrends. And they're just paused right now after their breakouts. They're just going sideways. They're resting before a big move comes. So when you look and you break it down, and another thing I look at is the size of these moves. So like how big is, say, this move here, to the peak? Is that a big move? If it's a really big move, it's a fractal of what could potentially come later, coming up when we do break out of things. I prefer to buy in this general vicinity here, this general vicinity here. Those are my favorite buy points. So I load in, you get like a little squeezing up pattern. It's at the bottom of a double bottom. And I like to load in there, and then I load in on the break, on the back test. Those are some low risk areas. And uranium has incredibly good setups across the entire board, and they have a lot of leverage. And uranium itself has a lot of leverage. Uranium, the physical price in relationship to other assets. It just means it's really volatile. And that is exactly what I look at. And the companies that I choose are usually companies that have low enterprise value in relationship to pounds in the ground. They have very good chart patterns, and they're moving in a positive direction. They're squeezing up, and I buy either in a pattern or on a support line. And that's really what I do. And then I go and look at the company. I go to their website. I look at their fundamentals. I say, are they making money? What's their break-even point? How many pounds do they have in the ground? What's the enterprise value? Calculate that out. And if it looks good and it compares good to the rest of the companies in the sectors, I'll probably go in. Is the jurisdiction good? I like Namibia. I like the pounds on the ground of Namibia. That's kind of where I'm focusing my efforts, is in Namibia. And I have other investments throughout the entire sector. But that's really how I attack approach a sector. I approach it looking at a big picture view of commodities. It's cheap. And then I drill down, okay, uranium's cheap in the commodity sector, because now you know that if uranium's cheap in commodities, it's way cheap compared to stocks. And then you drill down into the sector to see which companies are the best to play, which vehicles. And the way that I choose the vehicles is based off the chart and the patterns that they're creating. I would not get into a company that has a really bad chart pattern. I don't know. I haven't seen them work out well in the past. I'd rather choose a nice clean chart with really good valuation, with good fundamentals, and ride it. So that's kind of my approach to looking at these companies and how I approach the big picture view to certain sector, then to certain companies. And then always look for cash flow. If you're speculating, which a lot of these are, they're speculations because they still have to build things. They don't have cash flow. They don't have infrastructure in place yet. You're speculating on things. So it's a little more dangerous. If you have cash flows and it's a turnaround play, they went bankrupt, or the commodity's just low, like oil and gas was, and some of those. I prefer to lead into those a little bit more because the infrastructure's in place. There's less risk, and now you're just playing a leverage play to the commodity. So those are my favorite plays because you've got the value there. You just have to make sure the commodity comes back, and then you do charting with the commodity. You do ratios, and usually that's how I play it, and that's where I put my big bets. Is where the best value is. So obviously, it's going to be different when it's not commodities. We'll see the stocks start to outperform commodities, and we'll have to go and look at technology companies because interest rates going down in that market condition with low inflation will transfer money back into technology companies. But that's a long ways off, I think. But that's my approach. Hopefully you guys like it. Thumb up for the content. Subscribe to the channel. If you like the approach and you're looking for specific companies, definitely subscribe. Platinum membership to the website. That is below. And I share a whole bunch of different companies that look really good in different sectors. And I share the sectors what I think are the best sectors at this time. All right, guys, we'll catch you next time. This is Finding Value.